what we're in is not a trend to the downside. It's a trend towards greater volatility. We've been talking about this some time. There'll be up days like today. There'll be more down days as well. Brexit's a great example of how there are increasing concerns over the course of the next 4 months or so that are going to weigh on this market. We're going to have days to the upside, days to the downside as well.
So we are seeing a reaction, Jeff, in the British pound today. I mentioned a sharp slide against the euro and against the U.S. dollar. It doesn't seem to be impacting equities, either in Europe or the U.S. Is that just because it's 4 months away? Are we going to start to move on opinion polls?
I think we will start to move on opinion polls, but investors would be wise to ignore them. Remember, back during the Scottish referendum in 2014, the polls did not give a good indication as to where that was going to go. Obviously, Scotland stayed in the UK. And last year, the general election in the UK, the Conservatives won it outright, despite a very close polling number. So I do think the UK will elect to remain in the Eurozone, in the EU, but the polls will probably still be neck and neck. That means volatility, but investors would be wise to look through that.
Michael, can you just tell us about the economic risks to the U.S. on top of the Brexit? We know it would be harmful for Britain and potentially the EU. Is there any risk for the U.S.?
Well, there's some. I mean, I think Britain is the one that's going to bear the brunt of the cost of Brexit. I think it's going to have some impact on the EU, but it's more probably the ancillary questions about the stability of the European Union, how many other members might opt for some special arrangements. I think the direct economic spillovers are not going to be particularly large, particularly for the U.S.
All right, let's talk about our economy. The data's been a bit better. I mean, today's manufacturing number was a little bit weak and disappointing, but in general, do you buy this idea that underpinning the rally that we're seeing today and that we've seen over the last week is this idea that stocks overreacted to concerns about recession in the U.S., Michael?
I do think so. I do think that fear kind of trumped fundamentals for a bit there. And as you pointed out a minute ago, there's been a very high correlation between oil prices and what's happened with equities. And I think that is reflecting some concern that the drop in energy prices is a reflection of weak global demand. But I don't think you really see it in the data. And certainly the U.S. data has improved a bit over the last month or so.
Jeff, keeping that in mind, I also wanted to ask you about what's happening in the credit market. Still lagging equities in terms of the rebound, still elevated spreads, increasing risk there. Is that a red flag for this U.S. equity rally?
You know, I don't think so. Certainly it's something to keep an eye on. The markets are very worried about another financial crisis, a balance sheet issue that can spread from the banks around the world. Credit default swaps for U.S. and European banks are up. They're up to about 150 basis points, but that's a far cry from the 500 they reached in 08-09 or even in 2012 or 13. So certainly it points to some concerns, but more what we're seeing a weakness in the financials is around income statement issues, not balance statement issues. That means they're limited to earnings and not really something that's going to be a contagion, could pull down the global economy. I think the market is over discounted the risk of another global financial crisis.
So it sounds like what I'm hearing from you, Jeff, is that you're still worried about more volatility and the worst might not be over, but you're downplaying a lot of the major fears and concerns. So what exactly are you telling investors to do with this market?
You know, this is a market where there's going to be some significant volatility. Make sure you have an appropriate diversified asset allocation. This is not a time to go in and overweight the stock market on the dips. This is a time to adhere to that long-term allocation and ride out the volatility that allocation is designed to help you with.
Michael, we're going to get a lot of data, economic data this week, confidence, housing numbers, durable goods. Which one is most important?
So I think probably durable goods and consumer spending at the end of the week, because that's going to give us an indication whether Q1 is going to have the rebound that we're expecting after a very weak Q4. We get the updates to fourth quarter GDP growth towards the end of the week as well. And those will actually probably be to the downside. But I think the worst is behind us there. I actually think Q1 is probably going to be a fair bit north of 2%.
So who's going to lead us higher here, Jeff? Is it going to be the consumer discretionary stocks on the back of that kind of economic view that we saw last year? Or will it be some of the beaten down stocks, the value stocks that we started to see outperform last week?
Yeah, we may. I mean, if we get a little bit more relief in commodity prices, maybe on this deal between Russia and Saudi Arabia, maybe you get some of those deeper value names begin to bounce back. But, you know, I think financials are the key. They're the ones who've been the weak point to this market so far this year. We've got to see that sector firm up to really move the overall market higher.
Would you be buying them, the banks?
You know, I think from a long-term perspective, yes, they're attractive here. They're cheap. I don't think we're seeing the balance sheet issues the market's priced in. There's weakness in earnings right now, but if you look out a couple of years, I think the picture's a bit brighter.